No matter how high tax rates go, tax revenues never exceed 19.5% of GDP. W. Kurt Hauser.
Why can't we bring back the Eisenhower level 90% income tax rate of the 1950s? Welcome to Analyzing Finance with Nick. This video is a common question I get from audience who is more on the left side of the aisle who watches this channel. And they ask me like, Nick, in the 50s and the 60s, you had much higher tax rates than you did today. And they're in a much more balanced budget than today. Isn't the solution to the deficits just raising taxes on the rich back to the peaks that we had in the 50s? If it worked so well then, why won't it work today? And I'm going to answer that question. I did do a video just broadly taxing the rich back in December and about how just the math doesn't connect on a regular basis. But when it comes to why don't higher income taxes work and why did they work in the 50s and not today, I'm going to attempt to answer that in this video. First, I'm going to explain the concept of Hauser's law, which was the quote from the beginning of this video. Hauser's law is an empirical observation by Wall Street Journal writer W. Kurt Hauser in 1993 that no matter what the tax rates have been in post-World War II America, tax revenues have remained around 19.5% of GDP. And it hasn't made a difference whether the tax rate was over 90% or at the top tax rate is 37% today. And you've basically had federal tax revenue be a relative constant 17 to 20% of GDP with an average of 19.5% from 1950 to present. And even though Hauser made this observation in 1993, it still is held into the 2020s. So that is really the claim he's asserting. And basically, it doesn't do, the point is that other than class envy management, it doesn't do any good to keep top income tax rates high. And the question is, why didn't society fall apart when the top tax bracket was 90+% in the 50s? Well, there's a few reasons. One, the effective tax rate was much lower back then. You had a lot more deductions, like things such as credit card interest, for example, was tax deductible. And the increased amount of these loopholes basically made the effective tax, the top 1% paid, a lot lower than what it looked like on paper. So say, for example, in the 50s, when the top statutory rate was 91%, the actual effective taxes that the top 0.01% of Americans paid due to deductions and loopholes was closer to 30%, 30 to 45%, depending on what state you lived in. And in the 80s, when Reagan cut the top tax rate from 70% to 28%, the effective tax rate on the wealthy did go down, but it didn't go down by nearly as much as it looked like on paper. So it's, even though the statutory top rate went down from 70% to 28%, really the effective tax rate for these same people is now in a 22 to 35% range. And today it's really a similar, depending on people manage their taxes, whether it's capital gains or ordinary income, what state you live in. Yeah, the government even today is collecting 30 to 40% of people's effective income in the top 0.1%. So that is kind of really the difference. And most Republican tax reform has been to broaden the base, which means get rid of deductions and make more types of income taxable, but have a lower statutory tax rate to make taxes more transparent. The idea is if you have a lower tax rate, you're going to be more willing to comply and pay it. And there's less, and if there's no deductions and less deductions available, there'll be less effort being used to try to work around the taxes versus just paying a lower rate. And even the 2017 tax reform had similar thing. It cut the corporate tax rates and the top tax rates marginally, but it got rid of certain deductions such as the state and local tax deduction, which they put a $10,000 limit on. So if you look at over time, like now in 2024 and 2020 tax year, like the average effective tax rate on the top 0.1% is 26%, which is lower than the 30 to 45% range it was in the 50s, but it's significantly less of a gap than is as perceived. And it's even still higher than in the 80s. Like in the 80s, it was like about 22 to 25%. In the 2010s, 2020s is 24 to 28%. And so you've basically structured it. We've just changed how the taxes have been collected. The rate is lower, but the effective taxes collected is still about the same range. And the argument is that there's only so much blood you could squeeze out of a turnip. If you raised income taxes too high, not just the stated rate, but the effective rate, it would discourage people from actually willing to work hard and strive and advance. Like an income tax is basically a tax on productivity and effectively allocating capital and doing the right things for growth. That's why I generally dislike income taxes compared to property taxes, consumption taxes, or even tariffs for this very reason, because all taxes are net harmful for the economy, but I think the income tax is relatively more harmful for these very reasons. And I'm going to have charts effectively showing how the effective top tax rates for the top 1% and just taxes GDP have gone over time. And so the question really is, does Hauser's law apply in other countries? Because it seems like other countries are able to have much higher taxes as a percentage of their GDP than America does. And particularly on the federal level. The other thing too is that state income tax rates have gradually increased over time. California's income tax was instituted in 1935 at 3%. It went up to 6% in the 50s, and it went up to 9% in the 70s. And they had the top tax bracket as a product of the GFC went up to as high as 13.3%. And it's not just California. Most states have increased their state income taxes. In 1950, only 20 states even had a state income tax. Now in 2024, you have 41 states plus DC. There's 9 states still don't have an income tax, and Mississippi is going to likely be the 10th as they're in the process of phasing theirs out. But overall, the trend has been instituting more income taxes on the state level. And that is also maybe why even federal taxes look like they've come down a lot. A lot of that slack has moved to the state level. So, for example, in the 50s, the average state income tax rate for a state that had a tax was about 4%. And now it's closer to 7% in the 2020s. And so, however, some of the blue states started increasing their taxes a lot faster, particularly New York and California were the first states to break the 9% mark. And then you had other states like Connecticut, which started at 0%, and then it rapidly went up to one of the higher state tax rates from the 1990s to today. Now I think this trend might start to reverse. Like you've seen Hawaii cut state income taxes, and I mentioned the Mississippi trying to phase it out, and other states in the process of reducing income taxes. But it also explains why you don't have as high federal taxes, because a lot of the tax collection has moved down to the state level with the devolution of some government power. What about other countries? Does this Hauser's law apply to non-US jurisdictions? And the answer is no. If you look at European countries, they all have higher effective tax rates than California, with the exception of Switzerland and the UK. And those have continued to climb over the years. And in addition to that, it's not really, when it comes to European taxes, I did a video about this, the top tax rate isn't really that much higher than in America. The thing is, the base is a lot wider. So even in the UK, upper middle income people are paying much higher taxes than upper middle income people in the US or even California. So even if it's similar tax rates for the very wealthy, the middle class and upper middle class have much higher tax rates and a lot less deductions. And so as a result, the government can collect much higher tax rates because their tax systems are not as progressive as the US. It's more flat in the sense that everybody's paying high taxes. The other thing is that they've broadened the base to collect other kinds of taxes, most notably the VAT, the value added tax. And by these more indirect forms of taxation that European governments have, that the US doesn't, it allows them to collect taxes as a much bigger percentage of GDP. And as a byproduct, government spending is a lot bigger as a percentage of GDP. And I think another consequence is why these economies just do not grow as much and are less dynamic, and has other adverse effects such as demographics, cultural vigor, and just lack of entrepreneurial spirit in that part of the world. But I've done separate videos about that. So overall, Hauser's law shows, like, given the way that the US federal tax system is constructed and how American governments are more dependent on income taxes compared to other forms of taxation, such as consumption taxes and payroll taxes like they are in other countries, there's an effective cap in terms of GDP that the government can raise in form of tax revenues. So if you really want to balance the budget, as I've mentioned before, it is a spending problem, not a revenue problem. Thank you for watching. If you like these kind of videos about tax policy and deeper dives, please let me know in the comments. Do you think Hauser's law still applies? And do you think that America should have higher or lower tax rates than now? And if you do want to get rid of the income tax rate, how would you finance the government? Thank you for watching.